Have you ever wondered how the humble cowrie shell or a bar of gold evolved into the complex digital transactions we perform today? Yes, indeed, the journey of money is intriguing and diverse, just like our global financial markets. In the dawn of civilization, the barter system was the norm. Imagine trading a bushel of wheat for a pot of honey or a herd of sheep for a handcrafted plow. The challenge? The infamous double coincidence of wants, where both parties had to desire what the other was offering. Enter gold. Durable, divisible, and intrinsically valuable, gold became the common denominator for trade, transforming the way societies exchanged goods and services. This was the birth of the gold standard, a monetary system where a country's currency or paper money had a direct link to gold. This system gained prominence in the 19th century, providing a standardized measure of value that facilitated international trade. But, like all systems, the gold standard had its shortcomings. During economic downturns, the fixed exchange rates drastically limited the ability of policymakers to respond flexibly. The Great Depression of the 1930s was a stark example, forcing some nations to temporarily abandon the gold standard to stabilize their economies. In 1944, the Bretton Woods Agreement introduced a modified gold standard, tying currencies to the US dollar, which was itself pegged to gold. This system, however, collapsed in 1971 when the United States abandoned the gold convertibility of the dollar, ushering in the era of fiat money. Fiat money, the currency we use today, has no intrinsic value and is not backed by a physical commodity like gold. Its worth stems from the trust and confidence of its users. While this shift to fiat money gave governments greater control over their economies, it also introduced the risk of inflation, as there were no longer any constraints on expanding the money supply. So, what does all this have to do with forex trading? A lot, actually. The journey from barter to gold to fiat money has profoundly shaped the dynamics of currencies. Under the gold standard, exchange rates were fixed, directly influencing global trade and investment. The shift to fiat money introduced a floating exchange rate system, where currency values fluctuate based on market forces such as supply, demand, interest rates, and economic indicators. For forex traders, understanding these historical shifts is crucial. It helps them analyze economic policies, central bank decisions, and global economic trends, anticipating currency movements and making informed trading decisions. The forex market, highly sensitive to economic shifts and policy changes, is a real-time reflection of the ongoing impact of these historical transitions on the value of fiat currencies worldwide. So the next time you make a trade, remember, you're not just dealing with numbers, you're participating in a system that has been thousands of years in the making.